Profitability ratios. Profitability ratios measure a firm's ability to generate profits. There are a number of common profitability ratios, which we're going to discuss. The first is gross profit margin. This is sales minus cost of goods sold divided by sales. As discussed earlier, gross profit margin is a measure of how efficiently a company converts its cost of goods sold into sales. Profit margin on sales is the second profitability ratios. This is net income divided by net sales. The profit margin on sales measures your company's efficiency in converting sales into net income. The third ratio is return on assets. This is net income divided by average total assets. Return on assets, or ROA, measures the efficiency with which your company is utilizing its assets to generate net income. The fourth measure of profitability is return on equity. This is net income to common stakeholders' average shareholders' equity. Return on equity, ROE, measures the profits generated for each dollar of equity invested. The next is earnings per share. This is net income to common stockholders divided by weighted average shares outstanding. Earnings per share, or EPS, is a popular profitability ratio, measuring the portion of a company's earnings allocated to each outstanding share of common stock. And next we have price to earnings ratio. This is market price of stock divided by the earnings per share. The price to earnings, or P divided by E, is a measure of the quality of a company's earnings, that is, how much investors will pay per dollar of earnings. And last, we have payout ratio. This is cash dividends divided by net income. Payout ratio indicates the percentage of earnings distributed to shareholders in the form of dividends.